Institutional research houses love order book pipelines because future promises look great in a discounted cash flow model. But retail investors live on cash in hand, not pipeline projections. DBS just reiterated a $3 price target on Seatrium. And that number is asking you to fund an operational turnaround while accepting a dividend yield that fails every basic retirement hurdle in Singapore. I want to be upfront about something. I am not here to push stocks or manufacture excitement about the next big name. I am here for the Singaporean who is 5 years from retirement or already in it, the one who cannot afford to chase a yield that collapses when the balance sheet cracks. A $373 million half-year profit is easy to celebrate. DBS is leaning on a $32 billion pipeline to justify a $3 price target on top of that number. But when I look at Seatrium through the lens of a CPF or SRS portfolio that needs reliable distribution, the balance sheet tells a far more nuanced story than either of those headline figures suggest. So let's start with the analyst's actual case. This slide lays out the official call from DBS research analyst Pei Hua Ho, issued on August 3, 2026. DBS maintains a BY rating with a $3 price target against a trading price of $2.21. That implies substantial upside on paper, driven entirely by forward operational assumptions. Here are the 3 pillars behind that call. First, margin expansion, where gross margins are projected to grow from 8.9% in the first half of 2026 toward 15% by 2028, aided by over $50 million in annualized cost savings from non-core asset sales like the Amfels yard and tugboats. Second, a $32 billion order book pipeline over 24 months anchored by the potential $4 billion Petrobras P88 contract. Third, an ongoing share buyback program intended to support the stock price. All 3 pillars rest on one core assumption, and that's worth pulling apart. This call hinges entirely on one load-bearing assumption. DBS assumes Seatrium will convert its $32 billion pipeline into high-margin contracts quickly enough to prevent a revenue cliff beyond 2026, all while lifting gross margins toward 15%. If order book conversion stalls, the entire growth projection breaks down. So let's test that assumption against the forensic screen, starting with dividend yield. The dividend yield sits at just 1.35%, 3 cents per share on an 18.42% payout ratio. Historically, Seatrium paid 20 to 30 cents before a 6-year dividend drought from 2019 to 2024. Payouts resumed at 1.5 cents in May 2025 and reached 3 cents in May 2026, but the wallet impact is stark. For a 55-year-old Singaporean investor putting $100,000 into this stock, a 1.35% yield generates just $1,350 a year, falling far short of passive risk-free options. Even if the payout ratio doubles to 36.8%, the yield only reaches 2.70%, still failing both our 3.2% forensic floor and our 4.7% hurdle rate. Now let's look at debt coverage. The measurement window changes the conclusion here, and that matters. On a Q2 quarterly run rate basis, interest coverage sits comfortably at 5.0 times. Earnings before interest and taxes of $341.1 million against $68.1 million in interest expense. But on a full first half basis, coverage drops to 3.9 times, $561.1 million of earnings against $142.5 million in interest, failing our 4.0 times floor. A 10% rise in borrowing costs or heavier working capital usage would push that half-year coverage deeper into vulnerable territory. Which brings us to gearing. Net gearing looks different depending on how you treat finance leases. Excluding them, net debt of $678.2 million gives a net gearing ratio of 9.24%. Including them, net debt rises to $1.065 billion, pushing gearing to 14.5% against $7.338 billion in equity. Both figures comfortably pass our 35% ceiling, so the balance sheet is free from immediate solvency distress, though the least inclusive figure paints the more accurate liability picture. Here's how it all adds up. The checklist consolidates every finding so far. Dividend yield fails at 1.35% against the 3.2% floor. Gearing passes under both methodologies, 9.24% and 14.5%. Interest coverage fails on the first half reading of 3.9 times but passes on the Q2 run rate of 5.0 times. And Investing Pro's quantitative fair value indicates 20% upside at $2.65 against the current $2.21 price. Before we go further, here's how these rules apply to every stock I cover, not just this one. Every stock I screen is tested against a 3.2% yield floor, a 4.7% yield hurdle, a 35% gearing ceiling, and a 4 times interest coverage floor, all benchmarked against the CPF special account rate of 4.0%. A stock clearing every gate with zero soft flags earns Zone 1, Fortress. A stock failing on yield or carrying a structural red flag drops to Zone 5, Red Zone, because this system does not soften for a good story. Now the soft flag tally. There are zero major flags here, because core operational earnings and margins are genuinely expanding. Two minor flags at 0.5 each. One for the first half interest coverage shortfall at 3.9 times, another for customer concentration risk tied to Petrobras tenders in Brazil. That brings the weighted total to 1.0, though the yield floor breach on its own is already enough to drive the verdict. Let's look at the dividend history behind that yield. Seatrium's distribution profile reflects a capital-intensive industrial business emerging from corporate restructuring, not a mature income utility. Management is prioritizing balance sheet strength, operational execution, and working capital over cash payouts to shareholders. Here's what that looks like across the years. Between 2016 and 2018, Seatrium paid 20 to 30 cents per share at payout ratios above 80%. Payouts dropped to zero during the distress period from 2019 to 2024, before resuming at 1.5 cents in May 2025 and reaching 3 cents in May 2026. Even under a forward projection where 2027 distributions rise to 4.5 cents on a 25% payout ratio. The yield only reaches 2.04% at current prices. Quick note before we go further. In this market, the difference between a cash flow sanctuary and a yield trap is decided in a single trading session. Free subscribers read yesterday's news. Iggy's elite investors cross-check live balance sheet setups together in real time. Members receive zero-day forensic breakdowns the moment research is finalized before the market opens. They get direct access to the full Red Zone watch list and institutional cheat sheets built around this same 5-layer framework. Now back to the gap between what DBS sees and what the screen shows. This is the fundamental divide between Wall Street models and retail realities. DBS rates the stocker buy with a $3 target based on $32 billion in pipeline opportunities and a 15% margin goal. Our forensic screen assigns a Zone 5 Red Zone rating based on the 1.35% yield. Broker DCF models project 2 to 3 years out. This framework focuses on immediate income sustainability and distribution capacity. So why does that gap exist in the first place? Institutional analysts evaluate Seatrium as a capital appreciation turnaround play, pricing in the probability of winning a $4 billion Petrobras contract and reaching 15% gross margins by 2028. This framework evaluates the stock as an income asset for a retirement portfolio instead. A 1.35% yield sits below our 3.2% floor, failing to compensate investors for operational execution risk, while order book coverage has fallen to roughly 1.3 years of revenue. Here's the part that ties it all together. DBS's $3 price target relies on flawless execution, assuming Seatrium converts its $32 billion pipeline quickly enough to replace its shrinking backlog without margin slippage. But balance sheet analysis is about window precision. Measure interest coverage on a first half basis and it's 3.9 times. Measure it on a Q2 run rate and it's 5.0 times. Include finance leases in gearing and it moves from 9.2% to 14.5%. Institutional targets buy the projection, but retirement portfolios require cash flow and order book coverage pays the bills, not pipeline promises. None of that changes the core issue though. The yield itself sits below the forensic floor before any of this nuance is even weighed. Here's what I'm watching next. 3 triggers matter here. First, the Petrobras Albacora P88 final investment decision. Expected late 2026, failing to secure that $3 to $4 billion FPSO job would leave a severe revenue gap beyond 2026. Second half gross margins need to sustain above 9.0%, confirming that $50 million in annualized cost savings is actually flowing through. Third, the firm net order book needs to rebound from $13.3 billion back above $15 billion to restore revenue visibility beyond 12 months. Now capital upside versus income needs. A stock trading at $2.21 against an investing pro fair value of $2.65 offers genuine quantitation capital upside if operational targets are met. But for a CPF SA or SRS investor who needs an income anchor, a 1.35% yield means your capital is working for the company's capital expenditure, not for your monthly cash flow. Until order book replenishment translates directly into distribution growth, capital gains remain theoretical, while the yield shortfall is immediate. Never confuse a corporate turnaround with a retirement income sanctuary. Let's put a formal zone on this. Seatrium is assigned to Zone 5 Red Zone. It clears balance sheet solvency comfortably, with gearing well below our 35% ceiling. But it fails on 2 critical gates, a trailing dividend yield of 1.35% that breaches our 3.2% forensic floor, and a first half interest coverage of 3.9 times that falls short of our 4.0 times requirement. Under our rules, a yield failure lands a stock in the red zone regardless of balance sheet strength, which means the income this stock throws off today simply is not enough to draw down against in retirement. This is a structural verdict, not a timing call. The forensic flaw identifies names where the distribution cannot yet support a retirement drawdown regardless of how promising the operational story looks. Seatrium's operational recovery may well succeed, but its dividend, as structured today, is not built for the income role this framework screens for. So what's the actual benchmark behind that flaw? Our 4.7% yield hurdle and the 3.2% floor beneath it are anchored against guaranteed SGD risk-free alternatives, led by the 4.0% interest rate on the CPF special account. CPF contribution ceilings mean it isn't an open repository for all liquid capital, but it still serves as the benchmark for equity risk compensation. If Seatrium converts its pipeline and expands distributions as cash flows mature, the stock can be rescreened. Here's exactly what that path looks like. All three operational triggers need to materialize together before a forensic rescreen is warranted. Securing the Petrobras P88 contract, sustaining gross margins above 9%, and rebuilding the net order book past $15 billion. Pipeline promises alone will not change the zone assignment. Let's pull all of this together. The balance sheet is safe, gearing passes under both accounting methods. Interest coverage is improving on a quarterly run rate but remains tight on a half-year basis. And the 1.35% yield represents a structural breach of our floor, placing Seatrium firmly in Zone 5 red zone, unsuitable as a retirement income anchor today. So here's what actually matters going forward. Pipeline promises do not pay your monthly bills today, and measurement windows alter balance sheet readings significantly. While a future rescreening is possible if contract wins and margin expansion deliver higher payouts, the current distribution cannot support an income strategy. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. When a stock carries a yield below the risk-free rate alongside tight interest coverage, relying on institutional price targets can leave your portfolio exposed. Iggy's elite investors get 0-day access to our complete red zone watchlist and detailed cheat sheets before the market moves. So click the link in the description to secure your 7-day early access. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.
Let's make it happen.